And now let's enter in the deal number 4, which is represented by expansion financing. When we talk about expansion financing, we start talking about the financing of adult company. That means we exited from the world of venture capital, in which we have evidence of very young companies and startups. What is expansion financing? Expansion financing is the financing of the process of growth of the company. And coming back to basics of a strategy, probably you know that the expansion or the growth of the company can be managed into two different ways. On one hand, the growth could be internal or organic. That means the company grows by itself, just simply investing in new fixed assets or just simply enhancing working capital. On the other hand, growth could be external. This is much more complex because external growth means the company wants to buy another company, and the effect is to increase probably much more the amount of sales. When we talk about external growth, in many cases the company takes this decision to enter in a new market or to enter in a completely different business area. So as we have two different options, it is fundamental to understand what is the job of the private equity investor, as we have evidence of two very different jobs. The first one, for the internal growth, is honestly very simple. The second one, for external growth, it's honestly very complicated. Let's start with internal growth. In this case, the job of the private equity investor is, I want to exaggerate, is very simple, because the task of the private equity is to give money to the company to buy fixed assets or just simply to finance a working capital. I said it's a simple job because the company has got many alternatives. For example, using a mortgage, using an open line of credit, using bonds are honestly very effective alternatives. So the company decided to use a private equity for two reasons. The first reason is that there is a lot of private equity willing to give money to the company. That means money are very cheap in this case, because the company can easily select what's the best offer coming from the private equity world. On the other hand, the company would like to use the private equity for some benefits. For example, knowledge benefit or certification benefit. In this case, company needs money, but needs much more, because wants, for example, to penetrate a new market, and in this case, a bank giving a loans is not able to help the company to penetrate in a new market. However, this is the story of internal growth. But now we have also to discover the story of external growth, that using another label is a story of M&A, because in external growth, at the end of the day, the company wants to buy another company to increase the level and the amount of sale. In this case, the job, the role of the private equity is honestly much more complicated, because the private equity in this case is not simply a provider of money to buy the other company, but the role of the private equity is to be an advisor and a consultant of the company, and his job, it's really hands-on. The first step of an M&A process and the first job of the private equity investor is to help the company to scout the market and to identify the name of the company that makes sense to buy. This is honestly very common. For example, today we have many European companies willing to buy another company in India, in China, in Indonesia, in Brazil, but they do not have the knowledge to know the name of the company that makes sense to buy. So this is the first job of the private equity, to scout the market. The second job of the private equity is to start negotiating with the potential target if it makes sense or not to launch an M&A. The third job of the private equity is to give money to the company to buy the other one. In this case, we have two different alternatives. The first option we have on the table is that the private equity gives money to the company, receives share from the company, and the company has money enough to run the M&A. And if the M&A is successful, the company with the target are going to merge together. But we have also a second option. And the second option is that the private equity is going to create an SPV, where SPV means special purpose vehicle, is a NewCo, is an empty shell in which the private equity is going to put money with equity, the company as well. Together, they collect money from the banking system, and the SPV has cash enough to buy the other company. Typically, we use in the market the second option for two reasons. The first reason is that we need a lot of debt, and the company doesn't want to increase the amount of debt inside the balance sheet. The other option is related to the fact, using the SPV, we keep completely separated the characteristics, the profile, the value of the company from the value of the acquisition. That's, for example, very important when the company doesn't want to have the private equity having a benefit from the outcome of the merge. And the last step of the M&A process, driven again by the private equity, is to give legal and taxation support to run the acquisition and to organize the merge. So very different and very difficult activity that clearly demonstrate that we have a lot of strategic options on the table, and especially that the role of the private equity this time is very hands-on.